The ability to live off dividends is the dream for so many investors, yet there are so many misconceptions and misunderstandings when it comes to what this actually looks like and how to get there. In this video, we'll cover the mistakes investors make, how much you actually need at different income levels, and which funds are worth considering when you're ready to make the switch. I think the lure of this concept comes from the idea you can extract income from your portfolio without having to sell it. You don't have to worry about selling at the wrong time. You get the yield on top of any capital growth. That as an idea is fine, and we'll come on to what it actually looks like in practice. But in terms of getting there, there's varying ways to do it. The initial instinct is to start investing in high-paying dividend stocks early. Start off what's called the dividend snowball, where you reinvest all of the dividends, so over time you own more and more shares, and therefore the amount of dividend income you receive continuously increases. This can be a good strategy and keep you motivated because you're getting slightly more regular growth. Share prices tend to be more volatile than dividend payments. And with the right companies, even in a choppy market, you can still be receiving regular income, which you can reinvest. But what you've got to remember is that during accumulation, the only thing that matters is total return. All a dividend is a portion of company profits paid out to you as a shareholder. But if they didn't pay it out, you still own a proportion of that income through owning shares. That profit can be reinvested back into the business for future growth. It really depends on the type of business. A tech company will spend huge amounts on research and development and therefore less likely to pay out large dividends. And when they do have an increase in cash flow, what we've seen more recently is that they prefer to do share buybacks. This is where they'll purchase their own shares and then dispose of them, which reduces the supply and therefore leads to an increase in the share price. Whereas strong dividend-paying companies tend to be more mature, stable businesses that prefer to pay out profits as a reward to existing shareholders and an incentive to new ones. That's exactly what you want when you need the income, but it's not always the best option when accumulating. To illustrate this, here is the performance of an S&P 500 ETF over the past 10 years compared to a handful of dividend-focused ETFs. These performance figures include dividends being reinvested and net of fees. It shows even the best performing dividend fund underperformed the S&P 500 by around 50% during that period. I'm not saying you shouldn't use dividend funds to accumulate, and the results won't always be this way. All I'm saying is that you should be more focused on the quality of the companies you're investing in and their future potential overall. You can switch to distributing funds at any time. When you're ready to start taking income, a rough dividend yield to aim for is around 3 to 4%. There will be higher yields out there, but this is a more realistic and sustainable target. Why not higher, you ask? It's because yield and quality tend to be inversely correlated. It's not quite that black and white, but above 5%, you have to start really questioning the sustainability of that dividend. It's different when you're accumulating using dividends. You can accept some level of volatility. When you're using them for income, stability has to be a top priority. And because this is going to be paying an income, you also need that income to rise in line with inflation so it can keep up with your spending. This is where the quality element comes in, because to be deemed a reliable dividend payer, a company needs to have the cash flow to be able to sustain regular dividend increases. You don't want a company that just pays a big one-off dividend to attract new investors and then cut it straight away, or even worse, go into debt in order to keep paying it. Yes, that does happen. This is why you can't just simply look at yield, because it only tells a fraction of the story. For example, here's 2 funds you'll be tempted by, but you should probably avoid. If you go into Just ETF, filter by dividend in equity strategy, and then sort by yield, you'll find the Global X Super Dividend Fund with a yield of just over 9%, which sounds great until you dig a bit deeper. When analysing passive ETFs, it's essential you scrutinise the index it tracks. In this case, it's the Sole Active Global Super Dividend Index. So if we go to the index provider's website, we're looking for the methodology, which we can download here. You can put these documents into AI if you find it quicker. But if we scroll to page 6 of this document, we can see the main requirements are that stocks have a dividend yield of between 6 and 20%. As well as a market cap of at least $500 million. When it comes to selection on the next page, it explains those companies are then ranked by yield and the top 100 are chosen. This should be a massive red flag because there is no other criteria. And when we look at its performance, although it has actually performed well recently, over 3 years, without dividends included, it's essentially flat. So all you're doing is giving up capital growth in return for income. And even that has been steadily reducing, as you can see by the previous dividend payments. Another option you may be tempted by is covered call ETFs, such as this one, the JP Morgan Global Equity Premium Income Active Fund. This has a current dividend yield of just over 8%. I'm not going to go into this in too much detail, but all you need to know is that these funds are actively managed and they generate extra income by selling call options. That's a fancy way of saying you're selling the option to buy the stock at a specific price, known as the strike price, to someone else, and you'll receive a premium for it. But what that means is if the share price increases past the strike price, the buyer of that call option will exercise their right to buy the stock at the cheaper strike price and profit the difference. You've now had to sell those shares, and this means covered call strategies cap the potential upside. They can work well in sideways markets, but if there's a market crash, they haven't got the ability to recover like typical equity. I've got a couple of much better options to show you, but first let's look at what level of portfolio we would actually need to create an income. It's quite a simple calculation, and it really depends on what level of income you need. Is this to cover all of your spending, or is this to supplement other income sources? All of these figures will be gross of tax, which we'll come on to in just a moment. But for example, if you were able to receive a 3% yield and wanted £1,000 per month, you would need £400,000 invested. At £2,000 per month, it's £800,000 invested. And at £3,000 per month, it's a massive £1.2 million invested. At a 4% yield, it's slightly less. So £1,000 per month would be £300,000 invested. At £2,000 per month would be £600,000 invested. And £3,000 per month would be £900,000. The impact of inflation is covered by the potential for capital growth and dividend increases, although of course this won't be guaranteed. But it does reinforce the importance of quality over quantity with a strategy like this. In terms of tax, if you were able to build these level of sums inside of an ISA, then it's completely tax-free. And you don't need to worry about any dividend taxes or even any capital gains tax if you were to sell it. What's more likely is that you'll have a combination of investments in a pension and an ISA. The tax rate you'll pay will depend on other income sources and also what you choose to do with your pension. As an example, let's assume that all of the dividends will come from a defined contribution pension. You reach retirement age and you want £3,000 per month in dividends on top of the state pension. Now, usually with dividends, there are different tax rates compared to regular income. But with a pension, any money coming out, regardless of what type, is taxed using the regular income tax rates. So for this level of income, we would just be dealing with the 20% tax rate, as we wouldn't have hit the higher rate band yet. To keep this as simple as we can, let's just say that the state pension takes up all of the tax-free personal allowance. We want to receive £36,000 a year in dividends from the pension. If you haven't already taken it, you're able to withdraw 25% of the pension tax-free. So if you did this in this case, only £27,000 would be liable for tax. At 20%, you would pay £5,400 in tax. Annually, the dividend income would reduce to £30,600 a year, and per month, it would be £2,550. So you would need to factor that into any calculations. But remember, the pension will have benefited from tax relief on the money going in. If you're in the accumulation phase and you're thinking about using a strategy like this in the future, you may want to prioritize investing into an ISA, or at least ensure you've got a good balance between the two. So what would you actually use to create a dividend income? You've got two main options. You can pick individual companies or use a fund designed around income from dividends. There's always going to be more risk picking individual stocks than using a fund. This could pay off and allow you to get a higher yield, but this is income you need to live on. Stability, consistency, and diversification need to be your main priorities. With that in mind, I've got two options for you, one ETF and one investment trust. And these should be seen as just examples, not financial advice. One of my favorite dividend ETFs is the S&P Global Dividend Aristocrats Fund from State Street. It's designed to track the performance of high dividend yielding equities globally. But what makes this fund stand out is in the index construction. To be included in the index, companies must have increased dividends or at least maintain stable dividends for at least 10 consecutive years. The dividend payout ratio can't be more than 100%. That means their dividend payouts can't be more than their earnings. The dividend yield is capped at 10%. And there's also a diversification constraint, meaning the weight of each company is capped at 3%, and the weight of each sector is capped at 25%. So you can see this is a much more thorough set of requirements than most dividend funds. It has a current yield of just over 4%, and it pays out quarterly. So that is one thing you'll have to take into account if you were used to having monthly income. Performance-wise, it has averaged 8.65% over the past 5 years and 7.9% over the past 10 years. The other option you could look at is an investment trust. One of my favourites is the City of London Investment Trust. One of the biggest benefits of choosing an investment trust for this purpose is that they can use a revenue reserve. It means they're allowed to hold back up to 15% of income in good years to deploy in bad years. This can create smoother and more consistent payments than an ETF, which must pay out whatever the underlying companies produce in that period. What makes this particular investment trust stand out has to be its track record. 59 consecutive years of dividend increases. Those increases won't always beat inflation, but it gives you confidence that payments are very unlikely to go down. The current dividend growth rate is currently sitting at 2.86% with a yield of just over 4%. It has also a very healthy payout ratio of around 36%. It has an ongoing charge of 0.36%, which is a very competitive for actively managed fund. Over the past 10 years, it's returned 133.8%, which annualized is about 8.9% per year. The other thing you may want to consider would be also having a cash buffer. This is most important when you're selling down capital, as you don't want to be doing that in poor performing years. But with a dividend strategy, you could be tactical. So in poor performing years, you could spend your cash buffer and instead reinvest those dividends. If the dividend rate doesn't fall, you'll be benefiting from a falling share price as you'll get to buy more shares. Once it's recovered, you could then switch back to receiving dividends and top up the cash buffer back up. It requires a bit more active management, that approach, so it won't be for everyone. So to summarize, during the accumulation phase, just focus on total return. You don't need to optimize for yield. Think about the tax implications. A pension will allow you to grow the portfolio quicker, but you'll pay tax on the way out. An ISA may be slower growth, but when you're drawing income from it, you don't need to worry about any tax being taken. Aim for around 3 to 4% yield from a diversified blend of companies. Don't chase high yield and don't get tempted by fancy new products claiming they can produce high yields with no consequences, because it won't end well. When you're accumulating, your goal should be to get to the point where your portfolio is working harder than you are. To find out how to calculate that tipping point, watch this video next.